In a market where income remains a key priority for many investors, dividend strategies continue to play a central role. One index that's designed to tap into this demand is the S&P ASX 200 High Yield Select. Hello, I'm Andrew Geoghegan of ausbiz, and today we're exploring how this index works and why dividends matter in the Australian market. Joining me is Jason Yee, Director of Factors and Dividends Indices at S&P Dow Jones Indices. Welcome, Jason. Great to have you with us. Why do dividends matter to the Australian market?
So the Australian equity market is very well known for its high dividend yield and well-cultivated dividend culture here. So we see that dividends have become one of the fastest growing factor strategies in Australia. And there are several reasons why dividends have been traditionally so widely used in the Australian market. The first reason why dividend is important is that it's an important component of the total returns in the equity space. So if we break down the total return of the S&P ASX 200 historically, the index data shows a large portion of that total return has come from dividend and dividend reinvestment. The second reason why dividend is important is that it's an alternative source of income for from the equity market. So historically, this has been very important in the period when the fixed income market experienced a low yield regime, but the investors have continued to seek income elsewhere. So the dividend imputation system, in addition, also provides some extra income, especially when they're focusing on the high dividend yield companies. And the last reason is the historical performance. So in the paper we published, we conducted an empirical study, and we found that if we assign companies in the S&P ASX 300 into 6 groups, so one for the non-dividend payers and then 5 quintiles on the low dividend yield to the high dividend yield. So the group of stocks with high dividend yield historically outperformed the S&P ASX 300.
And Jason, can you walk us through how the S&P ASX 200 High Yield Select Index is constructed and how it aims to avoid common yield traps?
So the S&P ASX 200 High Yield Select Index was launched in October 2024, and it seeks to measure the performance of 50 stocks with the high dividend yield from the S&P ASX 200. It also incorporating several screens to avoid yield traps. So here is how the index is constructed. So starting with the S&P ASX 200 universe, excluding all the REITs, we first include stocks with a positive but maximum of 12% estimate dividend yield. Second, we calculate the momentum value of the stocks, and we exclude the companies ranked in the bottom 10% of the momentum value. Third, we select the 75 stocks with the highest 12 months estimate dividend yield, and while we capping the number of stocks from any gig sector at 15. And fourth, among the 75 high dividend yield stocks, exclude the 25 stocks with the highest volatility adjusted dividend yield. And lastly, we weight the stocks by the production of the dividend yield and the float market cap, and we apply stocks and sector capping to avoid the concentration risk. And this index is rebalanced semi-annually in January and July.
And Jason, walk us through the thinking behind the index design.
So the main consideration around some of this screening is to address the potential yield traps. So yield trap means that a high dividend yield may come from decreasing stock prices or unsustainable dividend payment. So the momentum screen could potentially exclude stocks whose high dividend yield is a result of dropping stock prices. And then the 12% yield cap basically excludes companies with unreasonably high dividend yield. And the risk-adjusted dividend yield is also an innovative design of the index. It will penalize the companies with high dividend yield, but then with high volatility. So think of 2 stocks have similar levels of dividend yields. The index would be more likely to select the stock with lower return volatility. And finally, using the forward-looking estimate dividend matrix, it may help to reflect the latest market expectations on the company's future dividend payment.
What are the key characteristics of the S&P ASX 200 High Dividend Index?
So based on the back-tested data, the S&P ASX 200 High Dividend Index demonstrated outperformance, higher dividend yield, and lower valuation against the broad market benchmark historically. The historical data in terms of performance also shows that some resilience in terms of the characteristics on the performance during the down market. So, which means that on average, the S&P ASX 200 High Yield Select Index tended to perform better than the underlying benchmark when the market was down. On the sector allocation, the index is more likely to overweight towards sectors with high dividend yield, such as financials, energy, and materials. And overall, the S&P ASX 200 High Yield Select Index is an innovative tool that can help inform market participants seeking income and are mindful of potential yield traps.
Jason, thanks again for your insights today. To learn more about the S&P ASX 200 High Yield Select Index and S&P Dow Jones Indices' latest data and research tracking markets across Australia, please visit the link below.